All right, today we're digging into the latest earnings from Land's End. Now, this one's a real head-scratcher. The market's reaction was, well, pretty brutal. And on the surface, it just doesn't quite add up. So let's unpack what's really going on here.
So here's how we're going to break it down. We'll start with what I'm calling the earnings paradox. Then we'll look at the headlines, the profit versus revenue story. From there, we'll get into the nitty-gritty behind the numbers, check out what management is thinking long-term, and wrap it all up with our take on what comes next.
Okay, first up, the earnings paradox. And yeah, that's exactly what it sounds like. A beat that totally bombed.
So this is really the big question, isn't it? I mean, think about it. Land's End comes out and beats earnings expectations by a whopping 24%. You'd think that's cause for celebration, right? Wrong. By the end of the day, the stock got hammered, dropping almost 9%. So what on earth did investors see that made them completely ignore such a strong profit number?
And this really brings us to the headlines. You could call it a tale of two tapes, because we're looking at two numbers that are telling completely different stories.
So first, let's look at the good news. On the bottom line, the story was fantastic. Adjusted earnings per share, or EPS, came in at 21 cents. That sailed past what analysts were expecting, which was around 17 cents. And get this, it's a 250% jump from what they did just a year ago. I mean, that's huge.
But, and this is a big but, the top line, the revenue number, told a completely different story. It came in at about $317.5 million. Now, that's basically flat compared to last year, which isn't great, but the real kicker? It was a major miss. Wall Street was looking for something closer to 331, maybe even 334 million. Ouch.
And this right here really lays out that disconnect perfectly. Look, on the one hand, you've got profitability metrics that are just singing. Gross margin is up. Adjusted EBITDA is up a solid 28%. That looks like a really healthy, well-run machine. But then you look at the other side. Total revenue is basically flat. And European e-commerce? My goodness, it fell off a cliff, down almost 21%. That's the conflict the market just could not look past.
So to really get what's causing that weakness at the top, we've got to peel back the onion a bit and look at how the different parts of the business are doing.
And wow, this table really tells the story. It's like an internal tug-of-war. Check this out. The Outfitters business, that's their B2B side, doing things like school uniforms, it's up a healthy 7.4%. And their third-party business, selling on places like Amazon, it exploded, up 34%. But all of that good stuff was basically canceled out by their main US e-commerce business being down and that massive, over 20% drop in Europe. So you might think this is all just a big mess. But if you listen to what management's saying, this isn't an accident. It's actually part of a deliberate strategy, focusing on profit over just chasing sales.
And here's the CEO, Andrew McClellan, basically saying as much. He's framing this whole quarter as a win. Notice he's not apologizing for the flat revenue. Nope, he's pointing straight to profitability and that 28% EBITDA growth. The message here is crystal clear. They are intentionally stepping back from bad sales, the ones that require huge discounts, to project the brand and make more money on every item they do sell.
So what does this long game actually involve? Well, first, they're being way more disciplined with promotions. No more endless sales just to move product. Second, they're using marketplaces like Amazon as a flywheel to find new customers. And they're also moving to what's called an asset-light model, using partners more. Oh, and then there's the elephant in the room. The board is exploring strategic alternatives. Let's be real. That's just Wall Street talk for, we might sell the company.
All right, with all that in mind, it's time for our take. Let's look at what's coming up in the holiday season and give our final verdict on the stock.
So, looking ahead, management's guidance for the crucial fourth quarter, well, it's pretty ambitious. They're telling the street they expect to do between $460 and $490 million in revenue and deliver somewhere between 71 and 84 cents in adjusted EPS. To be blunt, that's a pretty heavy lift for the holiday season. They're going to need pretty much everything to go right to hit those numbers.
Okay, before I give you our rating, just a quick definition so we're all on the same page. When we say market perform, we just mean we think the stock will probably perform about as well as the overall market, like the S&P 500, over the next year or so. No big surprises, up or down.
And that brings us to our official rating, market perform. Here's our thinking in a nutshell. The story about improving margins and profitability, it's real, we believe it. And that should put a sort of safety net, a valuation floor under the stock price. But, and it's the same but as before, until investors can actually see revenue start growing again, the stock is probably just going to tread water. It's stuck in neutral for now.
So putting it all together, what's a potential trade idea here? Will we see this as a catalyst-driven play? The situation is pretty clear. The stock got punished for that revenue miss. But the catalyst, the wild card, is that strategic review. What if they announce a sale? That could send the stock soaring. So one idea could be to go long on the stock to capture that potential M&A pop. But, and this is really important, you'd want to hedge your bets. You could pair that with some out-of-the-money puts, which is basically insurance against a bad holiday season, or if the board comes out and says, nope, no deal.
And of course, we have to end with our standard and very important disclaimer. Nothing you've heard here is financial advice.